It seems that a lot of this miss had to do with slumping valuations for some legacy assets, long-held oil fields. Is that why you weren't able to further capitalize on the gains we've seen in energy prices?
Well, good morning, Kaylee. We had some non-cash charges in the fourth quarter that are very difficult for analysts to anticipate and model. We'll go through that on the call here, and I think that they'll understand afterwards. When you look at cash, this was another record quarter. It's the second quarter in a row with record free cash flow, and our annual free cash flow was 25% higher than the best year we've ever seen before. So the underlying business is very healthy. We increased our dividend earlier this week by 6%, and that's the 35th year in a row where we've increased our dividend payout. It's up almost 20% since 2019, when others in the industry actually cut dividends through the pandemic. We yield twice what the 10-year yields right now on our dividend, and our share buybacks are at the top of the guidance range. So we're in a very, very strong place and set up for a really good 2022.
Mike, as you say, the top line looked amazing. The cash flow really strong. The share price has been on an absolute tear of late. And I'm just wondering, you mentioned the dividend and the buybacks. You've gone for a 6% increase in the dividend, as you say. You announced that a day or so back. My question to you is, are you favoring the dividend over buybacks because of that incredible run you've seen in the share price?
Well, we have many shareholders that really value the dividend. To your earlier segment about companies and industries that provide steady, reliable dividend growth over time. And so our shareholders really value the dividend. We have a robust capital program, which is down significantly from what it was just a few years ago. Very disciplined reinvestment to generate those future cash flows, a strong balance sheet. And then we have, in this environment, cash that's surplus to those needs. And we've got a history of returning that through share repurchases. We've actually repurchased shares 15 of the last 19 years. And so our investors understand our track record, and I think this is very consistent with what they expect to see.
Obviously, the run-up in your share price also has to do a lot with the run-up we've seen in oil. Brent, $91 a barrel, WTI, $88 a barrel. Do you anticipate $100 oil, and in what time frame?
Well, Kaylee, it's predicting oil prices is fraught with difficulty. We are in what has been an up market here now as the economy grows and we begin to put the pandemic behind us. And we've seen demand growth very strong, even before we see people returning to normal office commutes, international travel, or business travel returning to pre-pandemic levels. So demand has been strong. Supply has been struggling a little bit to keep up with that, and that's reflected in the market. And then, of course, we also have geopolitics that are present again. A few years ago, these types of events didn't seem to really impact commodity markets, and today they appear to be doing so. And so, $100 is certainly within the realm of what we could see in the next few months. Longer term, we think markets rebalance and prices will moderate.
You may get some extra production coming on stream, Mike, if we get to 100. Not saying you, but others might decide to make that decision. The word discipline is the word that I've heard most when I talk to energy CEOs at the moment. Every conversation I have seems to include the word discipline. Do you think that discipline is maintained? What are your plans going forward? If we get to $100 a barrel, what do your plans look like in the Permian? Are you going to be increasing production? How do you see the landscape developing?
Well, our production in 2021 was a record. It's the highest it's ever been. Permian was up 10% just quarter on quarter as we closed the year. And as we look to 2022, we've got a couple of big contracts in Asia that expire. And if you set those aside, we'll grow again 2 to 5% in 2022. So we're responding to the demand in markets, but we're doing it with capital discipline. That's a key word that you mentioned. Our budget is at the low end of our external guidance. And if you look at our company plus Noble Energy, who we acquired during the pandemic, in 2019, capital spending was twice what it was in 2021. So we're much more capital efficient today. We can generate the production and the growth in a much more capital efficient manner, which allows us to generate the free cash, which can then flow back to shareholders. That's our plan. Certainly others in the industry seem to have similar plans, and I think that discipline is what this industry has needed.
You mentioned there, Mike, both your strong capital position as well as a previous acquisition you have made. Do you see any more M&A in your near future to build out your asset base?
Well, Kayleigh, we've got a history of well-timed acquisitions over the years, and that's certainly part of our DNA. But the discipline that Guy referenced needs to apply in M&A as well. And in a market where commodity prices are elevated and equities are beginning to reflect that, I think we have to be very prudent in how we think about that. And so we're always on the alert for value-creating transactions for our shareholders, but we don't need to do anything unless it's really a deal that is a good one.
Mike, we broke the news just a few minutes ago that Wall Street firms are being briefed by the administration on possible sanctions if Russia goes in to the Ukraine, and what those sanctions might look like for the financial sector. The real concern over here in Europe is what that would mean for gas prices, for energy security. There has been some suggestion that the administration is trying to find a way to deal with that risk, possibly talking to Qatar. And I'm wondering whether the same conversations are happening with the big US energy companies such as yourself. Have you had any conversations with the administration? Do you think that the US could help Europe were there to be a gas crisis? Again, how do you see this story developing, and what role do you think you may play?
Guy, I'm not going to comment on what discussions we may or may not have had with the administration. I think there's been plenty of media reporting that indicates the U.S. administration and governments in Europe are sensitive to the current low level of gas inventories in Europe and the risks that exist should there be armed conflict that would break out in Ukraine. There's certainly a lot of gas that flows through Ukraine into Europe from Russia. The U.S. is producing a lot of gas and exporting it right now to Europe. The prices that we see in the market incentivize that, and we could see further strength in prices if these anxieties increase. Inventories in Europe are at a relatively low level for this time of year, and I think governments around the world are in contact with one another to understand what they might be able to do collectively to address that situation if it were to worsen. And certainly we operate around the world and would look to do what we could to support those kinds of efforts.